All right, let's get right to it. Look at Beyond Meat, ticker BYND. As I am speaking, the stock is trading at $3.62. That is not a typo. It is up $2.15 on the day, a move of 146%. This is not a drill, and this is not an orderly, fundamentally driven re-rating of the company. This is a wildfire. This is what happens when a stock that has been left for dead, a company that has been relentlessly shorted by hedge funds and cynical traders, suddenly gives the market a reason, any reason at all, to second-guess its imminent demise. What you are watching on your screen right now, whether it's on a professional interactive brokers platform or just checking the Robinhood app on your phone, is the anatomy of a historic short squeeze. The expectation for Beyond Meat for at least the last 18 months has been a simple, brutal downward slope to zero. The narrative was set. The plant-based boom was a fad. The products were too expensive. Competition from established food giants was overwhelming, and the company was bleeding cash with no end in sight. The expectation was bankruptcy. The reality, delivered this morning, is that the company might not be going bankrupt tomorrow. And in a stock this heavily shorted, not bankrupt tomorrow is the same as screaming fire in a crowded theater. The shorts are the crowd, and they are all trying to get out of the same tiny exit door at the exact same time. Let's be completely clear about the common ground here, the shared belief that built the mountain of short positions against this company. For years, investors, especially those new to online investing, looked at Beyond Meat as a story of what could have been. It had the explosive IPO, the high-flying momentum that reminded people of the early days of Tesla stock, a disruptive idea taking on a legacy industry. But the story fell apart. The reality of the grocery aisle set in. Consumers tried it, but repeat purchases faltered. The costs remained high while traditional meat prices fluctuated. Partnerships with major fast food chains fizzled out or were quietly scaled back. If you were using a self-investing tool or even a managed account like Schwab Intelligent Portfolios, this stock was likely flagged as high risk or sold off entirely as it breached one technical support level after another. The consensus was that this company was a broken growth story, full stop. The expectation was that any pop was a dead cat bounce, a brief twitch before the flatline. Today, that expectation was vaporized. This $2.15 move, this 146% explosion, was triggered by this morning's hypothetical third-quarter earnings report. But here is the critical insight, the part that separates the expectation from the reality. The report wasn't good, it was just less catastrophic than anticipated. The company, hypothetically, reported revenue that, while still down year over year, beat the whisper numbers that were circulating. But that wasn't the real fuse. The real explosive was the announcement of a massive strategic pivot. Management finally waved the white flag on global domination. They announced they are pulling out of most of their unprofitable international operations, cutting their workforce by a staggering, hypothetical 25%, and streamlining their product line. This is no longer a growth story. This is a survival story. The company's goal, stated this morning, is to become cash flow positive by 2026. This fundamentally changes the investment thesis. The shorts were betting on a company burning cash with no plan. Today, the company presented a plan. It's a painful, desperate plan, but it's a plan. And for shorts who had borrowed tens of millions of shares, betting on a $1 or $0.5 price target, this was a terrifying development. Let's break down the mechanics of what we are seeing today. The volume is astronomical. We're seeing hypothetically 150 million shares traded today against an average daily volume of perhaps 3 or 4 million. This is not your typical Fidelity mutual fund manager carefully adding to a position. This is chaos. This is forced buying. A short seller borrows a share at, say, $2 and sells it, hoping to buy it back at $1. $1. But when the stock rips to $3, then $3.50, their broker initiates a margin call. The Interactive Brokers trading platform literally forces them to buy back the share to close the position and limit their losses. Now multiply that panic by millions of shares. Simultaneously, algorithmic traders, momentum chasers on SoFi Invest, and retail traders on Robinhood stock trading see a stock up 100% and pile in, hoping to scalp a quick gain. This creates a feedback loop. The buying from the shorts forces the price up, which triggers more margin calls and attracts more momentum traders, which forces the price even higher. It's a vortex, and it's completely detached from the long-term fundamentals of whether someone is going to buy a Beyond Burger next week. This is a technical event of the highest order, punishing a trade that had become far too crowded. Many investors managing their individual brokerage accounts may be tempted to jump in, but this is an extremely dangerous environment. This is not the slow, steady compounding you see from Apple stock or the long-term tech thesis driving Nvidia stock. This is a structural market failure for one side of the trade. Now that we understand why the market is reacting this way, let's briefly step back and remember what Beyond Meat actually is, for those who are just tuning in because of this insane volatility. Beyond Meat was one of the pioneers in the modern plant-based meat substitute category. Founded in 2009, its mission was to create mass-market plant-based products, burgers, sausages, chicken strips, and ground beef that perfectly mimic the taste and texture of real meat, using ingredients like pea protein, fava beans, and brown rice. They aimed their products not just at vegans, but at meat eaters, placing their products directly in the meat aisle of supermarkets. The hype surrounding its 2019 IPO was immense. It was seen as a clean, sustainable food tech company. The stock soared from its $25 IPO to almost $240 within months. They secured high-profile partnerships with Starbucks, McDonald's, the McPlant, and Yum Brands, KFC, Pizza Hut. The expectation was that this was the future of food. But the reality was, and remains, incredibly difficult. The product is expensive to produce. The ingredient list is long and highly processed, which turned off some health-conscious consumers. And crucially, legacy giants like Tyson, Hormel, and even grocery brands like Kroger launched their own cheaper plant-based alternatives, flooding the market and crushing margins. The company's performance has been a painful lesson in market saturation and the difficulty of changing consumer habits. From $240 to just yesterday, under $150. It has been one of the most significant wealth destroyers on the market, wiping out billions in valuation. So, where does this leave us now? What is the future outlook after a 146% spike? This is where the investment help community and investing sites will be fiercely debating. The first risk is obvious. This is a squeeze. Squeezes end. When the last short seller has been forced to cover, the artificial buying pressure disappears. The only buyers left will be actual long-term investors, and they will look at the company's still negative cash flow and still declining revenues and ask if $3.62 is a fair price. It's highly probable that this stock gives back a significant portion of these gains in the coming days and weeks. Buying after a 146% move is often a recipe for disaster. This is not a starting point for a new online investment. This is the climax of a technical war. However, the catalyst for the bull case, the new expectation, is that this strategic pivot works. The bears were betting on a negative 40% gross margin. What if, by cutting costs and focusing on its most profitable products in the US, the company can get its margins to negative 10%, or even positive? The company doesn't have to conquer the world anymore. It just has to survive. This shift from growth at all costs to survival survival at all costs is the new reality. The question is whether they have enough cash to get there. They are still burning through their reserves, and this spite, while painful for shorts, doesn't actually put any new cash on the company's balance sheet, unless they decide to issue new shares at this inflated price, which would itself likely crash the stock. The entire landscape has been reset today. If you were holding this stock through Fidelity, perhaps in a long-forgotten Fidelity IRA's account, you're certainly happy today, but you have a difficult decision to make. Do you sell into this strength, believing it's a gift, or do you hold, believing this is the start of a legitimate turnaround? Many investors using Fidelity Investments or the Fidelity mobile app are probably logging in just to see if the ticker is broken. It's not broken, it's just exhibiting the most extreme volatility imaginable. This event shows just how dangerous shorting a stock with a low float and a recognizable brand name can be, even when the fundamentals seem to justify it. It's a lesson many traders are relearning today in the most expensive way possible. For those using SoFi investing or other platforms offering SoFi stocks and SoFi ETFs,